So imagine trying to, pull the trigger on the absolute largest financial transaction in your entire life.
Right, buying a house.
Exactly.
Yeah.
You've been running the numbers on a new house, but the economic reality right outside your window is just throwing absolute chaos at your spreadsheet.
Oh, yeah. Chaos is the right word.
I mean, you're looking at a 30-year fixed mortgage hovering right around 6.4, maybe 6.5%. You drive to the grocery store just to clear your head, and you immediately notice gas prices have spiked again.
Yeah, up significantly in just a few weeks.
Right. And while you're sitting there in the parking lot staring at the pump, you're reading a piece in the Wall Street Journal about how artificial intelligence is accelerating so fast that it's fundamentally restructuring your specific industry.
Leaving you with a very real, very heavy knot in your stomach about your own job security.
Exactly. Over the next 5 years, your career could look totally different. So flip the perspective. How does a massive, multi-billion-dollar corporation successfully manufacture and sell the classic American dream to you, the buyer, in that exact anxiety-ridden environment?
Honestly, it requires a masterclass in financial engineering and, operational discipline.
Yeah, it has to.
Because you are asking consumers to lock into a 3-decade liability at the exact moment their day-to-day confidence is just being battered by macroeconomic crosscurrents, things that are completely out of their control.
The friction there between the desire to own a home and the terror of actually executing it, it's palpable right now.
Totally palpable.
Which brings us to the core of what we are unpacking today on Talk Tickers. We have the Q2 2026 earnings call transcript from Lennar Corporation. They're one of the largest home builders in the United States.
A massive player.
And the mission for this deep dive is to get past the surface level corporate jargon, right? We want to look past the baseline headline numbers. We are going to decode the actual mechanics of how this company is surviving.
And in many ways, completely reinventing the concept of real estate development in this specific economy.
Okay, let's unpack this. We're diving into the mathematics of mortgage buydowns,
right,
the massive shift toward an asset-light balance sheet, and what this all signals for the broader U.S. housing market. If you are holding this stock or just considering it, we want to give you the actionable bottom line.
Because earnings calls from the major home builders are arguably the most accurate real-time thermometers for the broader U.S. economy.
Oh, for sure.
Like, a software company can mask weakness with deferred revenue, but you cannot hide from the macroeconomic reality when your product is a literal physical house.
Right. It requires an incredibly complex supply chain to build and a highly leveraged consumer to purchase it.
Exactly.
So before we get into Lennar's actual delivery numbers, we really need to establish the gravity of this economic backdrop they're operating in.
Yeah, we have to set the stage.
Because reading through this transcript, the macro environment they describe is, to put it mildly, hostile.
Hostile is definitely the right word. I mean, management spent a significant portion of the call laying out the headwinds before they even touched their own performance.
Which is pretty rare for an earnings call. Usually they want to jump straight to the good news.
Right. But the foundation of this hostility is just the stubbornness of mortgage rates.
They explicitly called out rates sitting in that 6.4 to 6.5% range. And sure, that might be like a slight reprieve from the peak 7% we saw a while back.
A very slight reprieve.
Yeah. But they highlighted a metric that really frames the severity of the affordability crisis. They noted that the buyer earning the median family income is currently spending above 30% of their gross income just on baseline housing needs.
And that 30% threshold is the historical tripwire in mortgage underwriting.
What do you mean by tripwire?
Well, once a household crosses that front-end debt-to-income ratio, meaning housing costs alone consume that much of their pre-tax income, you enter the territory of being cost-burdened.
So they're basically maxed out before they even buy groceries.
Exactly. The mathematical reality is that every other segment of consumer spending has to contract to service that mortgage. Discretionary retail, auto loans, retirement contributions.
They all take a hit.
Right. So when the median household is breaching that threshold just to get the keys, it tells you the market is operating with zero margin for error. Buyers are redlining their personal balance sheets.
I want to push on that, though. If buyers are already redlining, how much of that is driven by the mortgage rate versus the broader inflationary environment?
That's a great question.
Because the inflation picture Lennar painted in this call was highly specific and, frankly, a bit alarming.
Very alarming.
They pointed to the May 2026 Consumer Price Index coming in at 4.2% year over year.
No.
But it wasn't, a universal surge across all goods.
Right. It was acute. It was targeted, the core CPI, which, remember, strips out food and energy, was actually printing at a relatively tame 2.9%.
And it was showing signs of continued deceleration, right?
Yeah, it was cooling.
Right.
But headline inflation was dragged upward entirely by a massive shock in energy costs.
Oh man, the gas pump.
Exactly. Gasoline prices surged 7% in a single month and were up over 40% year over year.
40%. And they tied that directly to the geopolitical supply disruptions, right? The conflict in Iran.
Yes, but it creates this bizarre divergence for the investor. The Fed might look at the 2.9% core CPI and think, okay, things are cooling down.
But the consumer's living in the 4.2% reality.
Precisely, because energy costs are basically a regressive tax on consumer psychology. Core CPI is like an abstract economic construct. But the price of diesel and unleaded gasoline flashes in 6-foot neon numbers at every major intersection.
You literally can't ignore it.
You can't. When a family is absorbing a 40% year-over-year increase in their commuting costs, the resulting erosion of confidence is immediate.
Management made the point that energy inflation bleeds into the cost of groceries, goods, and services instantly.
It acts as a direct tax on the down payment savings rate of their target demographic.
So that economic pressure is super tangible. But then they introduced a psychological headwind that you rarely, if ever, hear on a home builder's earnings call.
Yeah, this was the wild card.
They didn't just talk about job numbers or wage growth. They spent real time discussing the existential anxiety surrounding artificial intelligence.
Which is absolutely fascinating. You typically expect a home builder to analyze regional unemployment data or household formation rates.
Right. Not existential dread.
Exactly. To pivot into tech-induced existential dread shows how deeply this specific technological cycle is permeating the broader consumer mindset.
They noted that foot traffic through their model communities remains incredibly high. So the underlying desire is there.
People are still showing up.
But they describe the buyers as lacking urgency. The intent is high, but the execution is totally stalled.
Yeah.
It reminds me of someone walking onto a luxury car lot, right? You have the down payment, you run the math, you're sitting in the leather seat.
He's ready to go.
But right before you walk into the finance office, you read a Slack message from a colleague about impending corporate restructuring. Because your firm just integrated a massive enterprise AI platform.
You are immediately walking off that lot.
You don't sign a 5-year auto loan, let alone a 30-year mortgage, when your career trajectory suddenly has a giant question mark hovering over it.
The delay mechanism you are describing is exactly what Lennar is observing. The structural shortage of housing remains. I mean, people fundamentally need shelter.
And millennials and Gen Z are in their prime household formation years.
Right. But the catalyst to transact is jammed. If you are a mid-level knowledge worker, taking on $500,000 of debt requires a 5 to 10-year horizon of assumed stability.
And the rapid deployment of AI is fracturing that assumption of stability.
Consumers are choosing the known discomfort of renting, or maybe staying in a cramped starter home, over the perceived risk of locking in massive debt during a total economic paradigm shift.
So the environment is characterized by 6.5% rates, a 40% spike in gas prices draining cash flow, and a pervasive fear of AI-driven structural unemployment.
It's a lot.
My question is, how does a builder look at that landscape and not just pack it up? Are they waiting for the Federal Reserve to step in and aggressively slash rates to bail out the consumer?
What's fascinating here is that management was remarkably blunt about this. The Fed is not coming to the rescue anytime soon.
Wow. Just taking it right off the table.
Completely. With headline inflation stubbornly anchored above 4% due to that energy shock, the federal funds rate is effectively immobilized in that 3.5 to 3.75% range.
So Lennar is operating under the strict assumption that the market environment they have today is the exact market environment they will have for the foreseeable future.
They are not modeling in any macroeconomic relief. They have to survive right now.
They are forced to play the hand they are dealt. But this is where the math on their actual Q2 performance gets really hard to reconcile.
Oh, the headline numbers are wild.
Right, because despite all of those headwinds, no Fed pivot, terrified consumers, redlined affordability, Lennar still delivered over 20,000 homes this quarter.
To be precise, they delivered 20,519 homes. And that actually landed perfectly in the midpoint of their prior guidance.
Which is huge for the stock.
Even more critically, they secured new orders for 21,749 homes, touching the high end of their estimates.
And what did that translate to for the bottom line?
It translated into an earnings per share of $1.31, a very solid beat.
Okay, wait, stop right there. If the buyer is tapped out and terrified, how are they accelerating orders and hitting an EPS of $1.31?
The key metric that Wall Street analysts zeroed in on during the Q&A gives us the answer, but we really need to dissect how it actually functions.
Let's do it.
Lennar's sales incentive rate on deliveries dropped to 12.9%.
Okay, wait. The context for that 12.9% figure is vital, right?
Extremely vital. In the first quarter, the incentive rate was 14.1%, and at the close of 2025, it was 14.5%.
So we are looking at a sequential, meaningful compression in how much margin they're giving away to secure a sale.
Yes, which is a massively bullish signal.
I think we need to define what a sales incentive actually is in this context, because the average person hears incentive and thinks of, like, a manufacturer rebate or a simple price cut on the sticker price of the home.
Right, like buying a car on President's Day.
Exactly. But in the world of institutional home building, it's a much more complex financial instrument.
Extremely complex. While a builder can simply drop the base price of the home, doing so is highly destructive to the comparable sales values in the rest of the subdivision.
Because it angers recent buyers who paid full price.
Exactly, and it depreciates the entire asset class. So instead of touching the headline price, the vast majority of that 12.9% incentive pool is allocated to mortgage rate buydowns and closing cost assistance.
Let's walk through the mechanics of a rate buydown.
Yeah.
Because this is the exact lever they're using to bypass the affordability crisis we just talked about.
The foundational concept is that a buyer does not qualify for a home based on the total purchase price.
Which feels counterintuitive to a lot of people.
It does, but they qualify based strictly on the monthly payment relative to their gross income, that debt-to-income ratio we mentioned earlier.
And Lennar knows this.
They know it perfectly.
Yeah.
So rather than dropping the price of a $400,000 home by $20,000, which honestly might only save the buyer a little over $100 a month, Lennar takes that $20,000 in corporate cash and pays it directly to the mortgage lender at closing.
Boom.
In exchange, the lender buys down the interest rate on the loan from the market rate of 6.5% down to, say, 4.5 or 5%. And that can be either temporary or permanent.
So it's essentially Lennar subsidizing the yield that the secondary mortgage market demands.
That's a great way to put it.
They are fronting the cash to offset the investor's yield requirement, which drastically lowers the monthly payment for the buyer.
And it allows the buyer to slide under that 30% debt-to-income threshold and actually secure the loan, even though the actual sticker price of the home hasn't moved an inch.
Here's where it gets really interesting, though. The math on this still feels a little contradictory.
How so?
Well, if Lennar is pulling back on incentives dropping from 14.5% down to 12.9%, that means they are offering less financial assistance to the buyer.
Mathematically, yes.
Yet, we just established that the macro environment hasn't improved. Rates are still high, gas is up, anxiety is high. How are they successfully reducing their incentives, which improve their gross margins to 15.6%, without totally suffocating their order volume?
It comes down to a combination of underlying demand inelasticity and highly targeted localized pricing power.
Break that down for the retail investor.
First, despite the anxiety, life events still occur. People get married, they have children, they relocate for work, and they eventually outgrow apartments.
Right, life doesn't stop for the CPI data.
Exactly. There is a baseline of transaction volume that must happen regardless of the macro environment. Furthermore, the resale market is completely paralyzed by the lock-in effect.
Oh, the golden handcuffs.
Yes.
Anyone with a 3% mortgage from 2021 is refusing to sell their home and take on a new 6.5% rate. So existing home inventory is historically starved.
Precisely. Because the resale market is frozen, the home builders are essentially the only game in town if you want to buy a house.
That's a huge advantage.
It's massive. Lennar recognizes this quasi-monopoly on available inventory. They are using highly sophisticated, data-driven, dynamic pricing models to figure out the exact minimum buy-down required to close a specific buyer in a specific zip code.
So they aren't offering a blanket 14% incentive anymore.
No, they are micro-targeting. If they only need to offer a 10% incentive to move a unit in Florida, but they need 15% in Texas, they balance that to achieve the blended 12.9%.
Which is why Wall Street is so hyper-focused on that 12.9% number. For the last 2 years, investors were terrified that builders were trapped in a race to the bottom.
The thesis was that as long as rates stayed high, builders would have to continually bleed out their profit margins to keep volume flowing.
Yeah, but the fact that Lennar successfully reduced incentives while simultaneously increasing order volume is a massive signal that their pricing power is holding.
It validates the sustainability of their margin profile. Hitting a 15.6% gross margin while delivering 20,000 homes in this macro environment is a testament to incredible cost control.
But this brings us to a huge structural question.
Right.
If Lennar is continually diverting huge sums of cash, even at a reduced 12.9% rate to buy down mortgages, that capital has to come from somewhere.
Right.
It should theoretically be crushing their balance sheet.
Right.
But their balance sheet is immaculate.
It really is.
To understand how that is mathematically possible, we have to look at the absolute transformation of how they handle the foundational element of real estate, dirt.
The shift toward their asset-light, land-light model is arguably the most significant structural evolution in the history of production home building.
Let's look at the numbers they reported, because they are genuinely staggering. Lennar disclosed that they only own 2% of the land they build on directly on their balance sheet. 2%.
It's unheard of historically.
Right. They control the other 98%, which equates to roughly 484,000 individual home sites through third parties and land banks.
Yeah.
Let me stop you there, because historically being a home builder meant being a massive land speculator, right?
Absolutely. The traditional life cycle of a home builder involved raising massive amounts of debt to purchase thousands of acres of raw, unentitled land.
Just sitting on dirt.
Exactly. The builder would then carry that land on their balance sheet for 3 to 7 years, paying property taxes, interest expense, and entitlement costs as they slowly navigated zoning boards and laid down horizontal infrastructure, roads, sewers, electrical grids.
And the fatal flaw of that model is the holding cost.
It is the ultimate vulnerability. Real estate is cyclical. If a macroeconomic shock hits like the 2008 financial crisis, or a sudden spike in rates, sales volume stops.
But the interest payments on the billions of dollars of debt used to buy that raw land do not stop.
Never. Historically, builders didn't go bankrupt because they couldn't build houses. They went bankrupt because the carrying costs of their land banks suffocated their cash flow when the revenue spigot turned off.
They were catastrophically land rich and cash poor.
Exactly.
So Lennar looked at that structural vulnerability and decided to completely divest from the land speculation business. But how does this 98% control actually function?
It's all about off-balance sheet structures.
Right. If they don't own the land, but they are building 80,000 houses a year on it, what exactly is the legal and financial mechanism bridging that gap? They mentioned something on the call repeatedly: option maintenance fees and ACOR.
Yes. So to execute this, Lennar utilizes off-balance sheet special purpose vehicles, commonly referred to as land banks.
Okay, translate that for us.
Essentially, Lennar identifies a parcel of land they want to develop. But instead of buying it themselves, they arrange for a third-party institutional investor like private equity, a dedicated land fund, or a joint venture to purchase the title to the land outright.
So the institutional investor takes on the massive upfront capital burden and the associated debt.
Correct. Lennar then enters into an option agreement with that land bank. This contract gives Lennar the right, but crucially not the obligation, to purchase individual lots from the land bank at a predetermined price.
On a strict schedule.
Right. Usually right before they are ready to pour the foundation.
So it functions almost exactly like a call option in the equity markets. You pay a premium for the right to buy the asset at a strike price, which caps your downside risk.
That is the exact mechanism.
If the housing market completely collapses tomorrow, Lennar can legally walk away from the option contract. They lose the premium they paid, but they aren't stuck holding $1 billion of unsellable dirt.
Now, the land bank is not providing the service for free.
Obviously not.
They require a return on the capital they deployed to buy the land. This is where those option maintenance fees come in. Lennar pays the land bank a current pay fee, essentially a yield on the deployed capital to maintain the option.
And the acronym they use, ACR, often refers to these off-balance sheet capital structures.
Yes.
By paying this recurring maintenance fee, they keep the liability completely off their own GAAP balance sheet.
Exactly. From an accounting perspective, because Lennar doesn't hold the title and only has an option contract, the debt associated with that land does not appear on their books.
And the financial result is breathtaking. They reported that their total home building inventory declined to $10.9 billion.
Which is incredibly lean.
Yeah. And more importantly, their inventory turn, which measures how rapidly they convert inventory into sales, accelerated to 2.5 times, up from 1.8 times just a year ago.
It's a massive acceleration in efficiency.
But I have to push back on the identity of the company here. If Lennar is outsourcing the capital risk of land ownership to private equity, and they are just paying a premium to pull lots down on a just-in-time basis, are they actually a real estate company anymore? Or have they essentially transformed into a massive logistical supply chain and manufacturing firm that just happens to assemble residential housing units instead of automobiles?
Management would likely agree with your second definition.
Really?
On the call, the CEO explicitly outlined their transition into becoming a singularly focused home builder/manufacturer.
Wow.
By transferring the speculative risk of land development to third-party yield seekers, Lennar is consciously trading away a small percentage of their absolute gross margin, the option fees they pay out, in exchange for infinite survivability during a downturn.
And a massively improved return on invested capital, or ROIC.
Because ROIC is the metric that institutional shareholders actually care about.
If you can generate the same net profit using a fraction of the capital by keeping the land off your books, your return on equity skyrockets.
Precisely. They have completely deleveraged their operational model. They don't want to capture the speculative upside of land appreciation. They want to be a highly efficient, cash-generating assembly line that converts building materials into completed homes at the highest possible velocity.
And that transition to a manufacturing mindset brings us perfectly to the actual vertical construction of the homes. Because the efficiencies they are achieving on the physical build side are just as intense as the financial engineering on the land side.
The operational metrics they reported for Q2 are genuinely remarkable when placed in the context of the broader supply chain environment.
Yeah, let's look at the costs.
They announced that their vertical construction costs dropped to $81 per square foot.
I read that and had to double check the math. We just spent the first 20 minutes discussing how headline inflation is running at 4.2% and energy costs are up 40%.
Right, it doesn't seem to make sense.
The entire construction supply chain, from the diesel required to transport lumber to the petrochemicals used in PVC piping and asphalt shingles, is highly sensitive to energy prices. How is Lennar achieving a 7% year-over-year cost reduction and a 13% reduction over 2 years in an inflationary environment?
It is entirely driven by economies of scale and structural procurement advantages.
Talk to me about that.
A localized private home builder who builds like 50 custom homes a year is at the mercy of regional supply houses and spot market pricing for lumber, copper, and fixtures. They absorb the full brunt of inflation.
But Lennar is building over 80,000 homes a year.
Exactly. They do not buy from regional distributors. They bypass the middleman entirely and negotiate direct bulk procurement contracts with the global manufacturers of HVAC systems, flooring, and appliances.
So they're leveraging their sheer volume to force suppliers to compress their own margins.
Correct. But bulk purchasing only works if the product you are building is standardized.
Which brings us to their core product strategy.
Yes. This is where Lennar's core product and everything's included strategy becomes the engine of their cost reduction.
Let's break that down because it fundamentally alters the consumer experience of buying a new build.
It really does.
Historically, building a new house meant walking into a design center and making hundreds of bespoke decisions. You pick the exact cabinet wood, the specific drawer pulls, the exact shade of granite, the specific manufacturer of the plumbing fixtures.
And from a manufacturing standpoint, bespoke customization is a logistical nightmare.
Why is that?
If a buyer selects a custom Italian tile and that specific shipment gets delayed at a port, the entire construction schedule for that specific house grinds to a halt. The drywallers can't finish, the plumbers can't set the fixtures, and the capital tied up in that house just sits idle.
So Lennar's everything's included model eliminates that variability entirely.
It does.
They analyze market data to determine what finishes the vast majority of consumers want, and they simply make those premium finishes standard across the board. You don't get to pick the brand of cabinets. The house comes with a highly spec'd, pre-selected cabinet package.
It is the exact same manufacturing philosophy applied to automotive assembly.
Like Henry Ford, right?
Exactly. When you purchase a mass-market vehicle, you don't dictate the brand of the alternator or the material of the exhaust manifold. You select a trim package and a color.
So by severely restricting the number of stock keeping units, or CUs, in their supply chain, Lennar creates massive predictability.
They know exactly how many linear feet of a specific baseboard they need for the next 10,000 houses, and they can source it globally at the absolute lowest cost.
Which also directly impacts their labor efficiency and build times. They reported a record low cycle time of 121 days.
That is incredibly fast.
That means they are taking a plot of dirt, pouring a foundation, framing the house, roughing in the mechanicals, finishing it, and handing over the keys in 4 months.
The standardization of the floor plans allows for what the industry calls even flow production.
Okay, what is that?
The framing crews, the electricians, and the plumbers are essentially moving from lot to lot, performing the exact same repetitive motions on the exact same floor plans. It eliminates the friction of tradesmen having to constantly interpret custom architectural drawings.
But the labor market isn't entirely smooth right now. They specifically noted some severe labor tightness in the transcript.
They did.
And ironically, the cause of that labor shortage circles right back to the psychological fear we discussed at the very beginning of the deep dive.
Yes, the data center boom.
It's all connected.
Management noted that while a slowdown in multifamily apartment construction has freed up some framing and drywall labor, the absolute explosion in data center construction to support artificial intelligence has created a massive vacuum for highly skilled trades.
Specifically commercial electricians and heavy mechanical installers.
Right.
It's the ultimate interconnected economy. The exact same AI revolution that is making the white-collar buyer terrified of losing their job and hesitant to sign a mortgage is simultaneously sucking up all the electrical labor in the Sun Belt to build massive server farms.
Making it harder and more expensive for Lennar to wire the very house that buyer is hesitating to purchase.
It is a perfect closed-loop macroeconomic paradox.
It really is. But despite that labor drain, Lennar's standardization allows them to utilize lower-skilled labor more effectively, mitigating the impact of the data center drain and maintaining that 121-day cycle time.
And they are applying this efficiency mandate to their own corporate overhead, too.
Yes. They highlighted ongoing investments in proprietary foundational technology, automating their marketing funnels, digitizing their land acquisition models, and streamlining customer engagement.
With the explicit goal of driving their SG&A, their selling, general, and administrative expenses, down to the 8.8 to 9% range for Q3.
Which is very lean for a builder of this size.
So we have a company that has successfully insulated its balance sheet from land risk, utilized bulk procurement to drive construction costs down to 81 to 1 per square foot, and optimized its supply chain to build a house in 4 months.
By every metric, the machine is humming.
Which makes their Q3 guidance, and specifically their full-year adjustment, arguably the most fascinating strategic pivot in the entire transcript.
It was certainly the moment that caught the attention of every institutional analyst on the call.
They laid out their Q3 expectations, targeting 21,000 to 22,000 new orders, 20,500 to 21,500 deliveries, an average sales price holding steady around $375,000 to $380,000, and a protected gross margin of 16%.
On the surface, highly robust guidance.
But then they casually announced that they are actively revising their full-year delivery guidance downward to a range of 82,000 to 83,000 homes.
They're deliberately choosing to build and deliver fewer homes for the fiscal year than they had previously projected to the market.
That feels like heresy in corporate America. Wall Street's entire valuation model is predicated on relentless quarter-over-quarter volume growth.
Usually, yes.
If you are operating at peak efficiency and your margins are improving, why in the world would you intentionally hit the brakes?
If we connect this to the bigger picture, it is a masterclass in capital discipline and cycle management.
Explain that, because it sounds crazy to just slow down when things are working.
The CEO explicitly stated that they are choosing to err on the side of prudence given the erratic nature of the macro crosscurrents. The interest rate volatility, the inflation stickiness, the geopolitical uncertainty.
So they see the clouds forming.
They are refusing to fall into the classic Wall Street trap of blindly pushing maximum volume into a fragile market.
Let's game out what would happen if they didn't hit the brakes. Let's say they run the manufacturing machine at redline, starting as many homes as physically possible to satisfy the growth mandate.
If they do that, they accumulate a massive pipeline of homes under construction. Now, imagine a scenario where the geopolitical situation deteriorates further, oil spikes to $120 a barrel, inflation reaccelerates, and the 30-year mortgage rate jumps to 7.5%.
Suddenly, that hesitant buyer pool completely evaporates.
And Lennar is left holding a massive inventory of completed, unsold homes.
Ouch. And the carrying costs of finished unsold inventory are highly toxic to ROIC.
Extremely toxic. To liquidate that trapped inventory and generate the cash flow required to operate, Lennar would be forced to capitulate.
They would have to massively spike their sales incentives.
Exactly. Jumping from that hard-fought 12.9% back up to 15 or 16%, aggressively buying down rates and slashing prices just to move the units.
Which would instantly obliterate the 15.6% gross margin they just spent the last year optimizing their supply chain to achieve.
It would be a self-inflicted margin collapse.
Wow.
By proactively slowing down their start pace to perfectly match their current sales pace, they are ensuring they maintain equilibrium.
They noted that their current inventory of completed unsold homes is sitting at just 2.1 per community, down from 3 per community in the prior quarter.
That is a highly defensive, incredibly lean inventory posture.
They are prioritizing margin preservation and cash flow generation over top-line vanity metrics. It's essentially saying, we have built the most efficient engine in the industry, but we are smart enough not to drive it at 150 miles per hour on an icy road.
It signals a level of maturity in management that institutional investors actually reward over the long term.
They are focusing on what they can control: their cost of capital, their operational efficiency, and their balance sheet.
Rather than attempting to force volume onto a consumer base that is visibly straining under macro pressures.
Okay, so Lennar can optimize their lumber purchases, they can structure brilliant off-balance sheet land derivatives, and they can ruthlessly manage their inventory levels.
Yeah, they have the internal mechanics locked down.
But there is one massive systemic variable that no amount of corporate engineering can control. And that brings us to the final major theme of the transcript: the looming shadow of government regulation and the danger of unintended consequences.
This was easily the most economically complex and structurally significant portion of the Q&A session.
So what does this all mean?
Management highlighted that the national housing shortage and the resulting affordability crisis have attracted an unprecedented level of attention from federal, state, and local governments.
The CEO noted that the level of scrutiny and proposed intervention at the highest levels of government is something he hasn't seen in his entire career.
And they weren't talking about standard policy tools like first-time homebuyer tax credits or municipal zoning reforms.
No, they were specifically highlighting a growing legislative momentum aimed at constraining, taxing, or outright banning institutional investors from purchasing single-family homes.
This is a direct response to the massive growth of the single-family rental, or SFR, and build-to-rent, BTR, asset classes over the last decade.
Where large private equity funds and institutional asset managers aggregate hundreds of thousands of single-family homes to operate as rental portfolios. Let's step back and look at this impartially, because the political friction here is intense. From the perspective of the average consumer listening to this deep dive, someone who is struggling to scrape together a 10% down payment, while fighting a 6.5% mortgage rate hearing that Congress might ban Wall Street from buying up starter homes, sounds like the greatest legislative idea of the century.
It's a very popular sentiment.
The prevailing narrative is that these massive institutions, armed with billions in cheap capital, swoop into neighborhoods, outbid regular families with all-cash offers, and permanently remove those homes from the ownership pool, driving up prices and killing the American dream.
That is the populist perspective, and it is grounded in the very real frustration of a starved resale market. The argument is that institutional capital crowds out retail buyers and artificially inflates asset values by acting as an indiscriminate buyer.
So if that legislation removes the big bad institutional buyer from the market, it should theoretically free up inventory and allow prices to cool, helping the regular family.
That's the theory.
But Lennar, a company whose entire business model relies on families buying homes, explicitly stated on the call that they view this legislative effort as a concerning long-term development. Why is the builder arguing that banning Wall Street will actually make the affordability crisis worse?
This raises an important question, and to understand Lennar's perspective, you have to look at the mechanics of housing production, specifically the supply-side elasticity.
Okay, lay it out for us.
Homebuilders are ultimately risk managers. When Lennar acquires the rights to a massive 500-lot subdivision, They have to deploy significant capital to develop the horizontal infrastructure, grading the land, putting in sewers, running electrical grids, paving streets before they ever pour a single foundation.
It's a massive upfront capital sink with a long duration of exposure.
Exactly. Now, in recent years, institutional SFR buyers have acted as a critical liquidity backstop for builders.
Like a safety net.
Yes. An institutional fund might approach Lennar and execute a forward commit contract, agreeing to purchase 50 or 100 of those homes in bulk directly from the builder before dirt is even moved.
So they are essentially providing guaranteed massive wholesale demand.
That guaranteed demand drastically alters the risk profile of the entire 500-lot project. Because Lennar knows they have 100 homes pre-sold to an institution, they can confidently secure the financing and pull the trigger to develop the infrastructure for the entire subdivision.
Those 100 institutional homes essentially subsidize the creation of the other 400 homes, which are then sold to retail families.
You nailed it.
I see the domino effect now. If a federal ban goes into effect and completely removes that institutional liquidity backstop, Lennar loses their guaranteed wholesale buyer.
And without that guaranteed demand mitigating their risk, builders will fundamentally recalibrate their capital deployment.
You just won't build as much.
Exactly. They will not take on the risk of developing a 500-lot community. They might only develop a 200-lot community. Or they might demand vastly higher internal rates of return before committing capital to a new project, meaning fewer projects get greenlit overall.
Which means the aggregate production of new housing units plummets.
Exactly. Lennar's argument is that institutional capital actually acts as a catalyst for new supply creation. If you legislate that capital out of the market, builders will produce fewer homes.
And the foundational law of economics dictates that if you restrict the supply of a necessary asset while structural demographic demand remains constant, the price of that asset will remain elevated or climb even higher.
It is the ultimate paradox of well-intentioned regulation.
By attempting to protect the retail buyer from institutional competition, the government might inadvertently destroy the very supply-side mechanisms required to build the volume of homes necessary to actually lower prices.
It's a fascinating high-stakes standoff between populist policy and capital market mechanics.
And it perfectly encapsulates the multidimensional chessboard that Lennar is forced to play on.
Yeah, they aren't just fighting interest rates and labor shortages. They have to continuously anticipate and navigate sweeping federal policy shifts that could fundamentally alter the liquidity profile of their primary product.
Which brings us to the culmination of this deep dive. When you synthesize everything we've extracted from this earnings call, you realize you are watching a legacy corporation completely re-engineer its DNA in real time to survive a hostile macroeconomic era.
It's an incredible pivot.
We started by mapping out a consumer base that is completely battered by the reality of a 6.5% mortgage rate, constrained by a 40% spike in gasoline prices eroding their discretionary income, and psychologically paralyzed by the threat of AI restructuring their careers.
And in direct response to that paralyzed consumer, we witnessed Lennar systematically dismantle the traditional home building model.
They have abandoned speculative land ownership, utilizing complex off-balance sheet special purpose vehicles and current pay option structures to control 484,000 lots without holding the debt.
They have aggressively transitioned into a highly efficient, asset-light manufacturing entity.
They are leveraging national bulk procurement and severe CU rationalization through their everything's included strategy to compress vertical construction costs down to $81 a square foot.
Accelerating cycle times to an astonishing 121 days despite fierce labor competition from the data center boom.
Furthermore, they are deploying that protected margin not into price cuts, but into sophisticated financial instruments, mortgage rate buydowns to mathematically reverse engineer an affordable monthly payment for a distressed consumer.
All while exercising the extraordinary corporate discipline to artificially cap their own volume growth, intentionally slowing down production to protect their balance sheet from future macro shocks.
It is a phenomenal display of adaptation. And this is exactly why decoding these transcripts is so vital for you, the listener.
Absolutely.
Whether you are currently hoarding cash for a down payment, analyzing real estate investment trusts, or simply trying to comprehend the economic forces shaping your community, understanding the underlying mechanics of a company like Lennar provides a massive analytical advantage.
You aren't just reading headlines about high rates and high prices anymore.
Right, you now understand the complex financial engineering, the supply chain logistics, and the capital market dynamics operating just beneath the surface of the housing market.
You possess the framework to understand why the market functions the way it does, rather than simply reacting to what it is doing.
Exactly. But I want to leave you with one final, slightly provocative thought to process. Throughout this deep dive, we have meticulously detailed how home builders are surviving by fundamentally altering the nature of the product.
The product is changing.
They are relying on intricate financial derivatives, third-party land banks, and option contracts to secure the dirt. They are utilizing absolute standardization and assembly line logistics to manufacture the homes as rapidly and cheaply as possible.
And we see the government increasingly treating single-family housing not as shelter, but as a heavily regulated financial asset class contested by global private equity.
The industrialization and financialization of the single-family home is nearly complete.
It really is.
So, the question you have to ask yourself is this. As the physical construction of a home becomes virtually indistinguishable from the mass production of a Honda Civic, and as the funding of subdivisions relies more on Wall Street debt structures than local community banking, are we witnessing the permanent extinction of the traditional American neighborhood?
That's a heavy question.
If the deeply personal, highly bespoke ideal of homeownership is entirely replaced by a hyper-optimized, standardized, institutionalized consumer product, what does that mean for the sociological fabric of how we actually live, interact, and build communities over the next decade?
The intersection of high finance and the human need for shelter will always yield complex consequences. It is something profound to consider the next time you drive past a massive fleet of earth movers creating a new 500-lot master-planned community.
That's all for this deep dive. Keep questioning the mechanics behind the headlines, and we'll catch you on the next one.